a high level is we'll focus on two risks: commodity, which we're going to talk about gold, and then exploration stage companies, which a lot of it relies on the resource. And this talk is about modeling resource, not deterministically with one number, but probabilistically, but using machine learning. Okay, so here we go. So this might be a bit much for the first talk in the morning, but you guys have had your coffee. And so the Lan Curve, and this is the first time I've given the Lan Curve with actual Pierre Lasson somewhere here. So this is something I modified back when I worked as an analyst for Canaccord. And so this was a transition, the typical Lan Curve, going from two different points of entry: exploration stage, development stage. Every company's journey, as we all know, is different. This is theoretical, but what I tried to do is break up the major risks and rewards, and so what we're looking at is the exploration stage, and so this talk will be focused on that. So we'll talk about grassroots to advanced exploration, usually very little technical data available, usually in terms of financing the highest cost of capital, equity raisings, they'll sell royalties, they'll basically do anything. The technical people running it are usually geologists or mining engineers. Sometimes you might get an accountant. But the risk profile is very high risk, high reward. This is your multiple bagger. But a lot of that risk, what we want to take is the uncertainty on the drill bit. We don't want to take the uncertainty on the management. We don't want to take the uncertainty on the jurisdiction if we can avoid it. But probably in terms of geopolitical risk, this has the least, because we're putting up the least amount of money. The concept can drag from 3 to 5 years. And that long wave does not always go with retail. Retail is more a short-term wave. This is a long-term wave. Like what I've thought about in exploration, it's what usually works and even doesn't, and it has a low probability of success, but it has probably a higher likelihood than other models, is well-funded. It doesn't need a lot of money. It needs consistent funding. What it needs is the same team. You don't want to keep replacing people. So you want to start off with a great technical team. You want to start off knowing you've got 3 to 5 years, and that way you can fail and still keep going. And so this environment is perfect for a risk lover. This is a lottery ticket. But in any kind of lottery ticket, you just don't want to buy it and turn your brain off. The idea here is trying to get a better idea that maybe you can buy a better lottery ticket with better odds. So we're going to focus on the gold price. And as you guys probably know as well as I do, the gold price did well, surprisingly, in the first half, despite the fact that real rates were actually flat to going up because of central bank buying. And so that lifted the gold price up the first half about 13%. When specifically the central banks, mostly out of China, stopped buying, gold flattened, but it didn't come down much. And then with the anticipation of the U.S. Federal Reserve cuts, which ended up coming, this is all data up to the end of September, it went up another 14%. So it is one of the best performing assets that I track weekly. Silver recently has outperformed gold. So when I did a Rick Rule classroom for people looking at royalty companies, I did a bit of research on how people looked at leverage to gold. And so I modified a graphic from Royal Gold here. And so I basically depicted the things people are looking at, risks and rewards. The leverage to gold is the big thing. Diversity in terms of lowering my risk with different assets. Some people want dividends. Exploration upside is what we're going to focus in on. Financing, which can be converted to cost of capital. Trading liquidity. So some people that enter this market in terms of exploration, it's a bit of a bear trap because you can get in, but you sometimes can't get out. So it's a bit like the Hotel California. And so the other thing is OpEx, CapEx. For most juniors, that's not an issue. But when people think about the remoteness of your project, they might consider that as to what's the viability. But interestingly, in terms of leverage to gold, the exploration companies probably provide the least because they don't make any. But what happens when the gold price goes up, their cost of capital gets lower. That's really the thing. And most of the money from retail goes to gold exploration. It's not divided up into all these different commodities evenly, even with the critical mineral movement. It's still mostly going to gold and silver. So even though we think that there's a lot of money being spent in exploration, it's not going to everything. It's mostly going to gold and silver because that's what the investors want. So most of what's driving jurisdiction and the other risk commodity is being driven by who gives you the money. And what they want is exposure to gold and silver. Okay, so in 2023, according to the S&P Global Market Intelligence, there was about 80 million ounces of gold produced. 782 mines, on average about 100,000 ounces per mine. So what you'll see is those jurisdictions like Australia, Canada, and the US will come up a lot because that's really where people want to give money to. Because they'll take the risk on the drill bit, but they don't want to take the risk on the jurisdiction. So you'll see that Russia produced a lot. You'll see that Uzbekistan, they don't have very many mines, but on average, each mine produces over 1 million ounces. So when I worked for Newmont, we were just getting out of Muruntau. Muruntau is still producing. It's still a big mine. But there's not a lot of exploration in Uzbekistan. China, the problem that we have, China is still top 5 producer, but it's hard to name a mine that we know in China. And what the reason is, on average, they only produce about 30 to 35,000 ounces a year per mine. So now let's compare that graphic with where the money's actually being spent. So this is $5.9 billion of exploration being spent in 2023, 1,342 companies. About 40% of exploration in gold is spent by juniors. That doesn't happen for every other commodity. This is probably the biggest exposure to juniors that there is in terms of exploration. So 55% of that money, because it's juniors and the people giving their money are retail, most US investors won't take high-risk countries. They'll only do low-risk countries. So they'll give you money as long as you're in the US, Canada, Australia, and used to be Mexico. Now it's not so much Mexico. And 70% of the companies, because there's more junior companies than there are senior companies, are operating in these 3 jurisdictions. So when you looked at the last slide, you could see Russia's top 3 producer. You look at the next slide, they're like, a top 10 exploration target. Why? Because these companies can't get money to go explore in Russia, and that, probably rightfully so. A lot of access to capital drives this. So then what is exploration doing? Well, exploration is all about growth. And so there's 2 ways to do it. You can drill for it or acquire it. So this graphic is about the percentage that I did for this first half results. And so this is just reserves, resources. It's mostly resources, sorry. So I took the total mineral inventory, which is measured, indicated, inferred, of all these producing companies, all North American listed, and took their inferred. So the measured and indicated gets converted to to reserves, but the inferred doesn't. So all their growth that they haven't touched yet and considered is in the inferred. And so you take that over the total mineral inventory, and I use that as a proxy for growth. It's not perfect, because some of these companies, and I did that at Newmont as well, we would have assets that we would never consider producing, that we never took off of inferred. So they'd be sitting on the books. We actually had some of those that were reserves that did that as well. So, somebody like Hecla, it made a lot of acquisitions during the time and overspent on some stuff, and that stuff stayed in inferred. It was never converted. So it might look like they have growth, but in terms of growth that actually can be converted, it's not as much as you think it is. So when you look at this graphic, it looks encouraging in terms of 25% they have potential upside to convert. But if you go dig into each one, it's really not like that. So, but you can get a proxy as to who needs to grow on the left-hand side. Easily Centerra Gold, cashed up, as well as they lost Kumtor. So that would be somebody that's looking to acquire something. And Allied Gold, that's more of a, they're growing based on West Africa and buying assets. Okay, and so this is global endowment. And so does that actually mean that if you had all the knowledge in the world of the Earth's crust, this is where all the gold is? No. This is where all the gold has been found by the people who've been funded to look for it. There's more ability for a big company to look in places that retail or institutional equity might not want to go, but they'll go there because they've got a longer timeline. It's harder for a junior to do that. And if 40% of the money is coming from retail, it's not going to go into these places. So that's why most of the gold is in that belt. Western US, Canada, South America on the west. Some of it is definitely endowment, but a lot of it, I mean, can Africa really have that paucity of gold? And also Central Asia, Russia. So 50% of the global resources of that 3.9 billion ounces total mineral inventory is actually in those same three countries. And 65% of those 1,785 projects. And so in terms of acquisitions, we had, I can't point, like maybe I could, we had this, Zijin Mining just bought a Chim from Newmont. We had Reunion Gold get acquired for its Oko West project by G Mining. We had a couple of silver acquisitions, Gato Silver by First Majestic. We had Coeur buying Silvercrest. Yeah, so we're seeing some M&A for gold. But what we're going to focus on is how to grow on the drill bit. So this is the number of drill holes drilled over 18 months between January 2023 to June 2024. So there's 486,680 drill holes. Less than 20%, which seemed high to me actually, had significant, or what's considered significant gold intersections. Again, 60 to 65%, again in those same three jurisdictions. Don't see a lot of Russia here. You're definitely not going to see anything from China there. It tends to be lower grade. So this was a conundrum. So every week, our social media feed is inundated by these graphics saying, okay, here's a bunch of 100-gram-meter intersections. These are the companies you want to look at. And we'll get them every week. We'll get them compiled for the quarter. We'll get them compiled for the year. And so what does that mean? So the question here is those people, investors, mostly retail, but could be smaller hedge funds, could be institutional equity, could be family offices, could even be sovereign wealth funds, could be royalty companies looking to buy a royalty that they think is plausible on a resource early. What do we do with that data? So the whole idea with this drilling, in the end, is not just to re-drill an old hole after the 4-month hold comes off and you can clip your warrant. There's actually a goal to actually get a resource. And so this is Oko West. The scoping study on the top in terms of production file was done by G Mining. The bottom part, the resource, that was done by Reunion Gold. I went to go see the project. It was very nice in terms of location. It was Essequibo, so that's where you had that one opportunity when Venezuela was looking to invade that region to actually buy it at a discount. After that, it wasn't available at that discount. So these are you need to look at cutoff grades, open pit, shallow, deep, needs a higher cutoff grade, 100% inferred. And if you're a junior, that's what you want to start off with, obviously. But you want continuity such that the major can come in, do their own numbers, and you don't have to drill it. I mean, the optimal would be Great Bear, where you don't even put out a resource. That would be nirvana for most juniors. So cost for mining, processing, G&A, all that determined by a peer group analysis, QP. All I'm talking about is it's a lot of work if you want to emulate it. But you can use those numbers to come up with a crude valuation. It's enterprise value per ounce. I'm not a huge advocate of it, but it just like other data, once you know the companies, you can dig into it, you can see where the problems lie. But so this is EV per ounce over reserves, proven and probable, and then also over total mineral inventory, which again, inferred, measured, and indicated. So it's not a difficult metric to calculate, and that's what's nice about it. So this is that same peer group that I showed you before in terms of producers, and you can see that the average EV per ounce, and this was taken for the end of September numbers in terms of EV, $200 per ounce per total metric, total mineral inventory, 475.76 for reserves. So those sort of valuations, once you know the resource, then you sort of say, well, where's my entry point? Do I come in now? Do I come in later? Is it too expensive? So it gives you a rough idea. I would still advocate for doing more due diligence than this, but it's a nice sort of way of comparing peer groups without having to do a net asset value calculation for everything. But I'm sure Red Cloud offers all that. So Red Cloud, Ron Stewart over here, puts out this graphic almost every month. And it's a great graphic to look at because not only his is more detailed in terms of he goes into seniors, intermediates, juniors, feasibility, exploration companies, and silver explorers, color-coded, but also he'll look producer versus explorer developer. So you can see the gap. $175 per ounce is comparable to my 200. He uses gold equivalent. I do gold only. And then he's got it for explorers and developers. And so you're talking $30 an ounce versus 175. Why the gap? Well, one person can convert it to cash flow, the other can't. But what you'll see is that every now and then, you'll see somebody up here. And then those guys are the ones that the market has realized that that could be a mine, and that could be an M&A candidate. And these ones will trade like a producer in terms of an EV per ounce. And so that's what we're looking for. We're looking for these unicorns. What we don't want are these guys. So most of what I'm going to show you is not about trying to figure out this dot from that dot. It's trying to find these guys and avoid those guys. So the problem, again, with retail, some institutional equity, smaller hedge funds, family offices, they can't do these mineral resource calculations in-house. They'll send it out to a consultant. They might have their own biases because we're all human. So somebody's going to define their project boundaries depending on what they know, compile the data the way they do it. It's almost like going to a doctor. You don't want to go to a doctor for something and only get one opinion. You want several. And you don't want an opinion by somebody you don't trust. So most of the time when I look at mineral resource inventories or mineral resource calculations, I look at the consulting name. And if it's a name I don't trust, I don't even bother reading it. And then I don't even bother looking at the company because I know why they went to them. So that's a great filter. But if you want to do this yourself, there's a lot of data, geological model. You got to understand the geology. You have to go to site probably. Did they composite the intervals? Variography. This is vital. This is what determines a lot of why a resource doesn't work or does work. And then we get to the grade estimation. And so not only would you like to have several consultants look at it, but it would be nice to see what it looks like in different estimation methodologies. Do you come up with the same number? A robust resource, which I don't like the word, not resource, but robust, is something that works in different estimation methodologies. And then you get into the classification. Somebody's inferred might be somebody else's indicated. So all that bias and all that knowledge base is something not everybody can do. So what are we doing? So I got to know this guy from Denver, Aaron McMahon from Tacit Vision. So he worked for RCF modeling resources, and that's what he did for a living. And so after he's modeled like hundreds of them, he decided like there's got to be a way to do this quicker. So given his computer background, he started producing a machine learning tool. And so what I'm advocating here is in your toolkit, this might be something to consider, but don't go brain dead. You still have to add your human intelligence in terms of understanding the geology and whether the machine has got it right. Again, all these machines need data, and it's got to be consistent data. You can't have a lot of data for one area and no data for the other and expect it to interpolate. It's going to recommend the one where it's got the most data, good or bad. So this is taken from 2.5 million publicly reported drill intersections. That's coming from 3,900 gold properties that produced 4,400 NI 43-101 resource estimates. So all the machine is learning is saying, okay, these are all the drill holes up to the cutoff. And then you get the resource, and it's saying, oh, all that data gave me this. And I'm doing that again and again for 4,400 projects. That's all I know. I don't know the geology. I don't know anything else. I just know what historically produced this resource. And so what you see in terms of those graphics, he'll produce one on grade and one on tonnage. He won't give you ounces. So some of you may or may not know this is a probability distribution. What's P10 and P90? That's the range we're going to look at. A P10 means that 10% of the data is going to be below that number, 90% is going to be above. So that's your downside. Your P90 is your upside. Only 10% of the data will be above that. 90% will be below. And so you'll get that in both. What I would be concerned about is where the grade falls on that more so than the tonnage is what we're finding. The grade is the big issue. So continuity is the thing that will drive how you calculate your variogram and that. So, but don't get confused and think that high grade means low continuity or high coefficient of variation. So this is a project I visited in, let's just call it the Fosterville district of Victoria. And you can see that this is done by grade of different vein sets. Those are the bars. And then what I've done is just showed you different continuity levels. So anything with a CV of less than 1, excellent continuity. Up to 2, good. It starts getting poorer after 2. After 5, it's bad. So you can see some of the worst continuity isn't at the high grade. But this is the kind of detail you've got to sink your teeth into when you're looking at these high grade deposits. So then let's look at the unicorn. So I was at Fosterville, what was it, 8 years ago or something like that? I can't remember. 2016, I think it was, when it was Crocodile Gold. So Crocodile Gold, no, sorry, was it Crocodile Gold? Crocodile Gold got bought by Newmarket, and then I went there with Newmarket. And so at that time, Fosterville went from an open pit heap leach on an oxide deposit to, when it went to sulfide, it was refractory sulfide, so they used a bio-ox, which only gave them 80% recovery. And it was just when I was there that they were starting to discover this other type of gold, which was coarse and associated with stibnite. And so they just put in a gravity circuit because they could get higher recovery. And so what this graphic is showing you is basically what the machine would do. The machine would take all the data up to that drill cutoff in terms of publicly available data. We haven't signed an NDA or anything with anybody. The machine is just getting data from the public. And so you can see on this graphic, so at Exploration Insights, my tendency is that, oh, hey, Newmarket got taken out by Kirkland. That's a win. Let's move on. But the problem is here for me was that if I'd seen this graphic in terms of the total distribution of grade from every resource, of those 4,000 plus, this is an outstanding grade. And it's falling within the distribution, saying it's predictable. And so when you look at the distribution, I can trust that that number's right. So if I had this graphic, I would have dug deeper and kept Kirkland, and I would have made more money. So this is all about trading as well. That's what this boils down to for anybody. How would you do things differently? So when I was in Victoria, was it last year? Or earlier this year, sorry. So I did a presentation about Fosterville for them. Wow, I'm already running out of time. So you can see the grade increase, the tonnage decrease, and the ounce increase. That went right into their throughput. Here, you can see that the grade went up, the tonnage went down. That converted to this, where they were getting actually better recovered grade because the recovery was 80% on the bio-ox, but it was like 95% for the coarse grain gold. So not only did they get higher grade, they processed less, and they had a higher recovery. All of that translated to higher margin, almost 80%. That would be the reason to hold that kind of project, but it's predictable, so you know that was real. So if we go on the other side of the spectrum, this is the Phoenix case. And so in January 2011, they came out with 6.2 million tons at 20 grams, over 4 million ounces. Redid the resource, 2013, tonnage doubled, grade halved, and now it's like about 3.3 million ounces. End game, 2 million tons, 6 grams, and about 400,000 ounces. So how would we look at that one? And so if we look here on the graphic, when that stock was going up, when they had the drill cut off and it went up, and then you saw this and you were wondering, well, do I buy it or not? Or if I owned it, do I sell it? So in terms of the probability distribution, we see the exact opposite. We see the reported grade here being beyond the distribution, suggesting that the computer couldn't even get to that number. So I would know, I don't know if that's right, but all I know is all I've got is downside. So my trading decision would have been sell without knowing anything else. I never owned that one. I covered it. But this sort of graphic would have helped me tell people not to buy it or not to hold it. Okay, I think I've only got a minute left. So I've got other examples that I can go through people with later. But, I mean, Oka West was a good one. That was taken out. The machine got the grade, got the tonnage. The grade was on the P90. Windfall, it got spot on. That was taken out. It got spot on for tons and for grade. Valley, which is yet to be acquired, but is probably one of the better deposits out there right now, got the tonnage right, but the grade was on the P90 side. So there might be a little bit of downside on the grade, but in terms of tons, no problems. So this is a summary graphic. So this is really what you want to look at. So what you want to avoid are these ones. So where the distribution of the grade does not cover the reported grade. And the CV, the coefficient of variation, is up to well over, I mean, that one was almost 17. Pretium was 26, but it worked. I see Ron shaking his head. So the other one that you want to look at is something like Fosterville, the next one. So you do get that same kind of spectacular grade, but the reported grade falls within the distribution, but also the variability is much lower. So those would be, the ones that you'd want to look on either side of that curve on the EV per ounce metric. Do I hold this one? Do I buy it? Do I sell it? This tool could help you, but again, it's only a tool. One of many things you should look at when you look at these high-risk assets. This is in terms of tonnage, in terms of up and downside. What's reported is the yellow dots, and the range is the P10, P90 for tonnage that the model predicted. Okay, I'll conclude there. So pre-resource exploration plays, again, that's the big risk, big reward. We think about them as lottery tickets, but the issue is that they don't necessarily have to be the same as lottery tickets. We try to evade geopolitical risk by funding mostly our so-called low-risk geopolitical risk jurisdictions like Canada, the US, and Australia. But we want to take the hit on the drilling because that's really where the risk is. But then as the drill results come out, how do we make head nor tail of those results? Am I paying too much for this stock, or is this the time that I should be buying? So this is a combination of machine learning and actually getting out and understanding. But you can filter so you could know which ones to do a deeper dive on. Because the problem is you can't do the same level of due diligence on everything. But you want to filter these things as quickly as possible. The enterprise value per ounce, once you sort of know the range, can give you an idea where you are in terms of the valuation chart. And as Ron does this every month, that's basically what you have to do. It's almost like a trading decision. So again, we're collaborating with Tacit Vision to bring these models for pre-resource deposits to basically get an idea of these companies that are putting out results and seeing if it's viable or not. And then Tacit Vision, not Exploration Insights, would put out a short report. If anybody wants to learn more about it, contact me, or you can get me through Red Cloud. Otherwise, yeah, that's it. Thank you.